Welcome to another episode from our Growth Tips series, a place to grow you, grow your business, and live the life you want to live. In this episode, we look at how to properly price your mileage rate. In this training, we're going to look at how you can properly price your mileage rates. By using the information you'll learn from this session, you'll be able to make more money. There'll be no more traveling 50 miles to a contract then discovering you made no money from it. In fact, you ended up paying for the fuel to get there yourself. You'll know how to make sure your fleet overheads are covered, especially as your business starts to grow. And you'll understand where your costs are and how they impact on whether you're charging the correct rates or not. Okay, so let's get into it. Why would you want to price your mileage rates properly? Without knowing what it costs you to run your vehicles, if you underprice your mileage rate by even 1 pence for every mile you drive to the customer, you're losing money from your own pocket. If you know what something costs you, you can make good decisions as to where you can travel to, but also what rate to charge your customer. And if your customer queries your mileage charges, just show them your calculations so they too can understand it. You cannot reliably grow your business without knowing if it's viable or know whether you're actually losing money. 90% of businesses close the doors before they reach 5 years, and only 4% make it to 10 years. The majority of small business owners are what we might call accidental business owners. They didn't really set out to grow a business. They might have been forced into self-employment, and as things got busier, they started to employ more staff. Now, whether that's your story, it doesn't matter, but we want to make sure the future doesn't happen by chance. Everything you do from now on will be on purpose. So much so that hopefully the future of your business will be predictable. We can be really busy and get carried away with the excitement of seeing the business growing quickly, but lose sight of the fact until the accountant's on the phone telling you there's a problem. Or worse still, maybe it's your bank manager. If we can reliably know how much it's costing to deliver a service, you can only then know at what level to price your services at. Now, if you know this, you'll know whether you're losing money. Good forward planning, if you price according to where you expect to be, it gives you that bridge between where you are now and where you want to be. And you should make it your obligation to periodically review these costs in the business, as well as the cost of delivery, overhead, and your mileage rates. Checking them against the previous rates, but also checking them against projected contracts to make sure you're not losing money by taking on additional resources and contracts. Growth doesn't come as an accident. This program is about making it happen on purpose. Now, if you haven't seen the training on how to price your services, please make sure to watch that and make yourself familiar with it before moving forward with this, as it's a really good foundation to work from and complements this training well. So how do we calculate your mileage rate? If your mileage or fleet costs are fixed, you could easily include them within your overhead and put it out as a cost per hour. You could do this, for example, when you have, say, a city centre contract. You know that the actual mileage travelled will be very small, but you need the vehicle there, so the cost has to be included somewhere. So using this example, you might have a normal hourly charge-out rate of, say, £32 per hour, but for one particular contract, you're charging £35 per hour. And the easiest way to calculate this is just calculate your total cost for the vehicles, calculate how many chargeable hours there are for the contract, and then just divide the two figures. But for this training, let's assume for this exercise, you're charging on a per mile basis for a vehicle. Look at your fleet of vehicles. If you have a van that's set up with certain equipment, you may include that as your calculation for the vehicle cost. Or you can include that equipment cost item as part of your overall business overhead. So in this example, we've got 3 vans which are chargeable, and they're traveling 15,000 miles per year each. We've got 1 car which is used by a sales manager who travels around the area finding new customers, and so their mileage can't be chargeable. That car does 20,000 miles per year. Calculating the running costs of the vehicles, we'll consider the finance cost for the vans, plus the insurance, plus the tax, and any maintenance to be 4,000 each, giving a total running cost for the 3 vans of 12,000. Doing the same exercise for the car, it comes out at 6,000. Next, we calculate the fuel costs. So the vans travel 15,000 miles per year, averaging 40 miles per gallon, meaning they'll each use 375 gallons of fuel every year. Now, assuming a fuel cost of £7 per gallon, that equates to 2,625 for each van, or 7,875 in total. Doing the same again for the car travels 20,000 miles, averaging 25 miles per gallon. This means it will use 800 gallons of fuel every year. Again, assuming the cost per gallon is the same at £7, the total fuel cost for the car will be 5,600 per year. In the worksheet, you can input the figures for every variable. So you can put the cost per litre for fuel, you can put the fuel efficiency of the vehicle, and you can put how many miles the vehicle travels every year. The calculator will then automatically generate everything for you and tell you how many gallons of fuel you'll use and the total cost. Now put that all together, and that means your total fleet running cost is 31,475 per year. Now let's look at the total chargeable mileage, and let's assume that all of the van mileage is chargeable minus 5%, but the car mileage is non-chargeable. This would mean a total mileage chargeable of 15,000 multiplied by 3 equals 45,000 miles minus 5%. So the total chargeable miles is 42,750 miles. Now if you have vehicle tracking software, you'll be able to constantly know what percentage of miles are non-chargeable for the vehicle to make sure you're always keeping on top of it. Now, as we did before with the overhead, we're going to take the total fleet cost and divide it by the chargeable miles. For example, 31,475 divided by 42,750, and that equals 74 pence per mile. Now if you want to add a contingency onto that, you can do. Again, if you want to add a profit markup, you can do that also. But the 74 pence rate is your minimum charge out rate to cover your costs. And again, our calculator tool lets you add contingency and profit figures. Now, as we did in the earlier overhead calculation, let's look at how we calculate for expected growth. Assuming we don't know how fast you're going to grow, let's look at the numbers as if it's already happened. So we'll assume you've now got 8 vans and 2 cars. And you've also now got a boom lift, which you're including in your fleet costs. So that's 8 vans at 4,000 equals 32,000. 2 cars at 6,000 equals 12,000. And 1 boom lift at 5,000. Now the boom lift is pretty much a fixed cost, so this could have been calculated as an overhead, but for this example we're choosing to spread the whole cost across every chargeable mile. This just means that every customer is paying for the equipment rather than the majority of customers who need it. So it's really up to you. Choose which way you want to price for that type of equipment. Either separate it or keep it as a big lot of fleet equipment, along with the other non-chargeable fleet equipment. So the fuel cost, taking the same rates and fuel efficiency as the previous example, the total fleet cost is now 81,200. The total chargeable mileage after the 5% reduction is 114,000 miles a year. So the cost per mile calculates to be 72 pence per mile. Now if you want to be clever, you can add in any allowances into that to reduce your total cost. That's up to you. Although personally, I'd leave it as it is, because who knows when allowances might be withdrawn or the rules changed by the government. At least by leaving them out of the calculation, your figures are reliant on things you can control, and you always know exactly where you stand. So now why don't you use the tool to calculate the total cost for your vehicles? Calculate how much chargeable mileage there is. Now, how does it work out for your current chargeout rate? How about if you add in some extra cost for the business growing? How does it look if you add 2 chargeable vehicles and 1 non-chargeable vehicle? If you added these new vehicles at your current rate, would you be losing money, or would you be at least breaking even? Have you calculated what your vehicle does miles per gallon? How fuel efficient is it? You could do a weighted average based on how many city miles you do compared to motorway cruising miles. Or you could just take an average and see how it works out. Our calculator tool separates every vehicle, so if you want to, you can group every vehicle together, or you can run a separate calculation for either environment. For example, if you've got 3 vans always city centre based, and then 10 vehicles that spend their life on the motorway, it gives you that option. And that's it. Thank you for watching. I hope you've got some value from this. If you think others will get some value from it, please invite them to join various social media groups and pages. As a bit of fun, after you complete the workbook, why not post how your current mileage rate compares with the calculated rate and post that in the social groups or on our pages. And that's it until the next time. Thanks for watching. I look forward to seeing you next time.